Hey, all, welcome to Strong Valley Monthly Market Matters, where we do a little recap of what's happened this month and maybe give a little preview into what we expect or what we're looking for in the months to follow. Kyle, you want to start a little bit with recap in August?
Yeah, we were just talking the other day, me and Adam and the other guys in the office here, and really referring to August as almost kind of the tale of two halves. So we started off the month pretty strong, and then the last week or so of the month, we kind of had a correction again here. So I want to start with just kind of updating you on the returns in the markets and the indexes here through the end of August, roughly. Bottom line is the major indexes in the U.S., the Dow, the S&P, and the NASDAQ were down about 3.5%, 4% for the month. Year to date, the Dow is down about 12. The S&P is down about 16, and the NASDAQ's down around 24. So, again, wanted to point out that we talked about a little bit before is that we've had a pretty strong recovery from essentially that June low, if you will, kind of middle of June 16th, 17th, depending on the index. But so the Dow is still up 6% since that low. S&P still up almost 10%, and then the NASDAQ still up about 11% from that low point. So we did give some of that up here, like I said, the last week and really for the month of August, but we're still kind of having a strong recovery through that June low. So international markets, for the month, the MSCI World Index is down about 5. Year to date, still down about 24, but it's had a pretty strong recovery from the June low of about 17%. So again, starting to recover, but we still have a long way to go. And the last area that I wanted to point out was the U.S. Ag Index, which essentially is our core bond index that we look at here. We've talked a lot about it in our quarterly roundtables and with client meetings that, the bonds have been a really big drag on our portfolios, especially with our more balanced accounts or even conservative accounts this year. Year to date, the U.S. Ag is still down 10%, which is a pretty good drop for fixed income for us. And for the month of August, it was down a little over 2%. And really, the part that we've highlighted is as we saw that recovery from June with the equity indexes, there really hasn't been much of a recovery in the bond market yet. And so we're only up about 1.5% from that June low, if you will, on the ag. So that just kind of brings us up to date on the numbers for the markets and the indexes here through the end of August, roughly, and kind of talk about what went on in the month of August. Next is, bottom line, like I said, mentioned tale of two halves. So we started off the month of August following a strong July with positive job growth from July being reported. Came in around 528,000 versus the expected 258,000, and a better than expected unemployment rate came in around 3.5%. So those gains were more than double what they were expecting and kind of showed a little bit of an acceleration over the past several months. Another thing that kind of came out a little bit in August, it's still positive for the markets, was the Q2 earnings were coming in better than expected as well, about 9% year over year. And lastly, the one area that really triggered the market rally in the month of July and August was the big thing we've talked about in our quarterly roundtables and with clients is inflation. It's been a big drag on the economy and on the markets for the year. And we kept saying that, we're looking for that to kind of flatten and maybe even pull back a little bit. And that's kind of what we got in the month of in the month of August here. The numbers from July came in at really unchanged, and that brought our 12-month average down from 9.1 to 8.5. So definitely don't want to spike the football at 8.5% inflation. And I know that we're still feeling it at the pumps, at the grocery store and all that. But
Kyle, a big part of that was energy, right?
Yep, energy came down quite a bit in the month. Yep, 100%. So that's kind of what helped us with the first half of August and really the positive numbers we were seeing. And
so then talk a little bit about the second half and what sent us the other direction here in August.
Well, our good friend at the Fed, Chairman Powell, in his Jackson Hole presentation or speech there, he made a few comments that the market didn't like, and in regards to inflation and interest rates. And so the main thing that I kind of took from it that we're talking about is really three areas that kind of surprised the market is that he still thinks that inflation is a top priority and it needs to be, it's still significantly higher than we were anticipating. And that's still forecasting another potential unusually large, was his term for it, rate hike in September. And so, prior to that meeting, a lot of the futures markets for the Fed funds rate was hinting at potentially a 50 basis point hike in September. And now we're looking again about a 75% chance that it's a 75 basis point hike again. So another large 0.75% hike. So that was one of the comments, and along with kind of just the magnitude and the duration of those rate hikes. So he didn't forecast any slowing in those rate hikes, and he still thinks that's going to be something they're going to be looking at here for the next couple months and through the end of the year potentially, and that really restoring that price stability will be the main thing they're focusing on, and that's going to take some time, he said. So those were really the comments that kind of threw the market for a little bit of spin here about a week and a half ago, and gave up about 5% since the highs of August. So
yeah, so like we talked about on the roundtable before, so the market's looking for inflation, to subside a little bit, which it did. So the market rallies a little bit, but that inflation, as we talked about before, all things are linked. So market is looking for inflation to subside, which will give them a signal that, maybe rate hikes are going to slow or stop, and then eventually they'll, loosen policy again. And so you get that first half of August going that direction, and then you get Powell's meeting with basically, what you thought. Basically what he's saying is what you thought was wrong. We're going to continue to raise rates. We don't think it's under control, and don't expect policy loosening, even with inflation ticking down.
And that goes a lot of what we've been talking about, is that even when we start to have some positive upticks in the markets, these are still very fragile and very volatile. And it's really hard to kind of look at a day-to-day or week-to-week analysis of any market or index. And so the volatility is still here, as we see. So
yeah, it may not feel like it, but we've been bumping along since, really early May. I mean, You go back to early May and you're about at the same levels as you are now, and, with ups and downs, but that's the nature of the environment we're in. Yep. So looking ahead to September, what things are we looking forward to?
Still just kind of staying on the whole market topic. I mean, right now, I know that we have coming up later in the year, we have the midterm elections, and I think we'll focus on that a little bit more as they get closer, because, a couple months in politics is forever. But really the things that we're looking at market-wise sound like, we're repeating ourselves a little bit, but it's a lot of the same. We should be having our next round of jobs numbers come out. The inflation numbers coming out here for the month of August, which is another big key point. So those are things that we'll really kind of focus on the data. And I think that's a lot what the Fed will be focused on as well. And so we're kind of looking to see what that looks like going forward, what those numbers show, and then whether or not, that leads to that 50 basis point or 75 basis point rate hike in September.
Okay. So on the topic of elections and politics, and a day can seem like a month, we thought we'd talk about something generally happening, in the U.S. as it relates to the markets, as it relates to the economy, and really more of an apolitical look. So if you haven't heard, you've probably been living under a rock, but student loan debt relief has been a big topic. You got the staunch for and staunch against. But like all things, you typically hear only, each side presents the side they want you to hear. So we thought we'd take a look at it a little bit apolitically, so more from an economic and market impact. And here's kind of how it breaks down. You got three players in the student loan market. You got students, obviously, both past and future borrowers. You have universities, obviously, collecting the income. They're charging tuition. But then you have government, and government's guaranteed the loans. So when you have something guaranteed, it makes it a different environment than purely market driven. So the focus by all the stuff I've seen and read, is the focus has been on whether or not $10,000 debt relief per borrower for those making $125,000 or less is a good idea. And it has both sides to it. Obviously, cost of tuition and college has been one of the fastest, if not the fastest growing inflationary item over the past 25, 30 years. So it has put people in a bind. But the real market impact should be focusing on the other side of this proposal, which is limiting future payments on debt to 5% of discretionary income, which they're defining as discretionary income is defined as above $30,000. So they figure first 30 you need, but then after 30, that's quote discretionary. So for example,
that's a huge part that we haven't really focused on. It seems like everybody keeps talking about the 10,000, but they don't realize how this continues to pay on and what that looks like for the long term.
And again, this is truly from a market impact. So
correct.
You're looking at $30,000. So somebody makes $70,000, or a family makes $70,000 a year. So your debt repayment at that point is limited to $2,000 a year, $2,000 regardless of your balance. And here's the kicker on all this. It's not that you pay it forever at this lower number. After 20 years, the debt disappears. So from a market impact, you're talking about increased borrowing since the repayment is capped at 20 years, and you got increased tuition costs, and so they're no longer an issue for the student or the family. I mean, if you have the opportunity to pay 5% of your discretionary income, and whatever you haven't paid down disappears over 20 years. I mean, you apply that to cars, you apply that to a house. In this case, it's education. Then the balance doesn't matter. You borrow whatever you want, borrow as much as you can. And then you got the universities who are on the other side of this. They have really no skin in the game other than they want to collect tuition money. If they know people can borrow as much as they want and only pay 5% of their discretionary income back over 20 years, and then the government absorbs it, which, by the way, the government, for those of us who don't understand, is us, because they don't have any money. This is taxpayer money. You're basically putting a much, much bigger burden on the federal government, the taxpayer, to foot these bills. And as we've discussed here in the first part of this segment, the market does not look favorably upon inflation, and you're adding a debt burden, and really this is a pretty inflationary policy.
I think that's a key point there too, Adam, as you talked about it, when they use a word forgiven or erased or removed or whatever the terminology you want to throw around,
canceled.
It doesn't just drop off, cancel. Yes. The government's making them whole. And so that leads to what you talked about is there's no incentive for tuitions or for universities to lower tuition. They can charge whatever they want, knowing that there's going to be a loan to pay for it. And at the end of the day, whatever the borrower pays back at the end of 20 years, the government's going to pay the rest. And so there's no risk of prepayment not payment. And all that increases usually taxes and more spending. And like you said, that's going to lead to more inflation and a burden on the taxpayers, in our opinion.
Yeah. So who knows if this goes through totally or as is or modified. But it's definitely something that the market won't sit well with, just because, again, you're looking to decrease inflation, you're looking to slow money supply, and you're encouraging more debt, more borrowing, and then more forgiveness and taxpayer burden. So that's our little student loan recap. Well, we appreciate everybody joining us. We'll do this again monthly. Hopefully you got a few insights out of it, what's happened, what to look forward to, and maybe a little something timely on what's going on in the economy. Thanks, you guys.
Thanks all for tuning in.